Good evening and welcome to a special edition of Modern Wall Street. I'm here at the New York Stock Exchange with Stephen Guilfoyle of Sarge 986, and he'll talk about fundamentals this week. Sarge, great to have you here as always.
Oh, thank you for having me, Remy.
Well, we may be in the middle of summer doldrums, but we do have a lot of event risk in terms of earnings, fundamentals, and Janet Yellen testifying before Congress. So given that we do have these fundamentals, how do you see that affecting global markets?
Well, we're going to try to ease into this, I think. But like you said, Janet Yellen is speaking the next couple days. Central banks have been quite hawkish in their rhetoric of late, not only the Fed, but the ECB, the Bank of Canada, and so forth. Not only that, but Janet Yellen and Bill Dudley and John Williams have all actually been speaking down the equity markets. They've been talking about valuations, which was really a place they don't normally go. So obviously it's something they're probably thinking about targeting. I'm not sure if they should go there, but it does seem like they're venturing there to see how the markets receive it.
And we're here on Monday, and last week we got that better than expected jobs report. At least for the headline figure, we saw a gain of 222,000 non-farm payrolls and the unemployment rate at 4.4. But given where we are right now in terms of inflation, what do you expect to see at the end of this week?
You know, I do believe the CPI will probably be about where it was last month. I think it's mildly alarming that there isn't the wage growth we expected, but on the same token, there was an increase in the average work week, 34.5. That's kind of huge. That's actually an increase in compensation, total compensation. So it is a building block, and it could be moving the right way. Now, obviously, the Fed's been raising rates. They're talking about going into an era of quantitative tightening, working on the balance sheet. That will tighten monetary conditions. This could be a headwind to the markets going forward. But if the economy is in place, then maybe it can be absorbed a lot better than it would be otherwise. I just don't know if the economy, one good jobs report doesn't make an economy. Let's see how the retail sales are on Friday. Let's see how CPI is on Friday. Let's see how industrial production and business inventories, they're all out on Friday. They're all red letter type macro events. Let's see how they come out.
And that retail sales figure will be important, as you mentioned. But before retail sales figures come out, we have Amazon Prime Day. Now, some consumers might be waiting all year for this event, but how do you see that affecting the company?
What I think it will do will be more than Amazon. It will impact the other retailers. If these numbers are, if these are blowout numbers, I'm flat Amazon right now, by the way. I bought it when it traded around 945, and then I sold it when it traded a little higher. But I think if these numbers are perceived as very good, that is going to hurt your Walmarts, which I am long, your Targets, a lot of these other retailers, more than it will help Amazon. I think right now we're in a little bit of a consolidation phase as far as the FANGs go. So I don't know how much it will help Amazon, but I think the brick and mortar retailers do face some risk this week.
And last but not least, before I let you go, Sarge, I do want to ask about government bond yields. Now, I know that you wrote an article recently for The Street talking about what we're seeing in terms of the global government bond space, but what do you expect to see as we head into the rest of the summer?
I don't know how much higher the 10-year can go. I mean, right now it's at 2.6 or so, 2.38 rather. I think 2.6 is a point of resistance. 2.75 is also resistance. I don't think it becomes a complete headwind for equity markets until it approaches 3%. I do like the financials because the spread between the 2-year and the 10-year is now approaching 1%, which is a reason why I like the banks at this point. I've gotten back into Citi and KeyBank. I'm also long Wells Fargo. Part of that is also because of the higher dividend and the increased buybacks that we saw coming out of the stress test. So there's more than one reason to right now have a little bit of faith in the banking space. But I think that's how you got to play it right now. As long as there is upward pressure on yields or downward pressure on bonds, that is your safest play right now, will be the financials.
Okay, Stephen, well, as always, great to have you here, and thank you for all your insight as always.
Thank you.